Ever wondered why some investors consistently outperform the market? What's the secret ingredient in their investment recipe? Well, it's often said that the stock market is a voting machine in the short term, but a weighing machine in the long term. This quote is attributed to none other than the father of value investing, Benjamin Graham. In the world of investing, Benjamin Graham is a name that needs no introduction. A mentor to the likes of Warren Buffett, Graham's investment strategies and principles have shaped the course of many successful investment careers. Imagine for a moment the story of a young investor. He's eager, motivated, and has a handful of cash to invest. Initially, he's tempted to follow the crowd, jumping into hot stocks and popular trends. But then he comes across the teachings of Benjamin Graham. Intrigued, he decides to dive deeper into Graham's investment philosophy. Graham's first principle is to always invest with a margin of safety. This means buying securities for less than their intrinsic value. The young investor realizes that he's been buying stocks based on hype, not value. He begins to scrutinize potential investments more carefully, considering their intrinsic value and potential for long-term growth. The second principle is to treat stock investing as ownership. When you buy a stock, you're not just buying a piece of paper, you're buying a piece of a business. The young investor starts to view stocks differently. He's not just looking for quick profits, he's looking for businesses that he'd be proud to own. The third principle is to be a defensive investor. This means diversifying your portfolio, investing in high-quality, stable companies, and not trying to time the market. The young investor, once a speculator, becomes a patient, cautious investor. He builds a diversified portfolio and invests in companies with solid fundamentals, not just those with soaring stock prices. Lastly, Graham advises to be independent. Don't follow the crowd. Make your own investment decisions based on thorough research and analysis. The young investor stops listening to hot stock tips and starts doing his own homework. He becomes a confident, independent investor. In the end, the young investor's portfolio starts to outperform the market. He's no longer chasing hot stocks. He's investing based on value, ownership, and independent analysis. And he owes it all to the teachings of Benjamin Graham. To summarize, Benjamin Graham's investment principles are timeless. Invest with a margin of safety. Treat stock investing as ownership. Be a defensive investor and be independent. These principles, when applied consistently, can lead to great success in the world of investing. So, next time you're about to make an investment decision, remember the teachings of Benjamin Graham. They might just be the secret ingredient in your investment recipe.